Something huge is happening right now in the global economy, and it's not what the headlines are telling you. The U.S. trade war that was supposed to weaken China is now backfiring, reshaping alliances, and putting American farmers, tech companies, and even Japan on the edge of crisis. If you want to stay ahead of these shifts and understand what they mean for your future, make sure to hit that subscribe button and turn on notifications, because we break these stories down every single week. The trade war may not be officially over, but let's be honest, Trump has run out of cards to play. Every move he makes looks weaker than the last, and the grip he once claimed to have is slipping fast. The much-hyped US-Russia summit went nowhere, with Putin flat-out refusing to even sit down with Zelensky. That tells us one thing: the Eastern Front remains wide open, and the economic pain tied to it is only beginning. Meanwhile, Russia is proving it isn't the least bit intimidated by Trump's tariffs. Almost 3 million barrels of crude oil per day are still making their way to India and China. And while Trump has tried to punish India with a fresh 25% tariff, it hardly matters. Moscow can redirect those shipments with ease, especially to the massive Chinese market and the wider BRICS bloc. And here's the reality nobody in Washington wants to admit: China is simply too big to sanction. Slapping Beijing with heavy secondary tariffs would unleash a tidal wave of retaliation, and the blowback on American companies inside China would be devastating. The official line from Trump and Treasury Secretary Bessent is that the goal is to cut Russian revenues. But the deeper truth is different. It's about stripping Chinese industries of their biggest advantage: access to cheap energy. Without Russian oil and gas, Chinese factories would face higher costs across the board. Manufacturing would slow, and the price of plastics and chemicals would climb. But instead of tightening the screws, Bessent has blinked. He's now sounding more like China's defense attorney, trying to rationalize Beijing's oil deals with Moscow. And while Washington hesitates on China, India is suddenly finding itself directly in the crosshairs.
China importing it is suboptimal, but if you go back and look pre-22, pre-invasion, 13% of China's oil was already coming from Russia. Now it's 16%, so China has a diversified input of their oil. India is just profiteering, or they are just profiteering. They are reselling. They've made $16 billion in excess profits, some of the richest families in India.
At this point, it's obvious. The trade war with China has failed. Everyone knows it. For months, we've been saying that the entire standoff has been more of a performance than a real strategy. Now, the curtain has finally dropped. The so-called showdown is over, and the United States has quietly waved the white flag, at least for now. And listen to the excuse being offered. Treasury Secretary Scott Bessent claims the current tariff structure with China is working pretty well. That's nothing more than code for admitting the fragile U.S. economic house of cards hasn't collapsed yet. So, better not rock the boat. But the reasoning is bizarre. Yes, China accounts for the single largest share of U.S. tariff revenue. But who's actually paying those tariffs? Not Chinese exporters. It's American importers, U.S. businesses, and ultimately American consumers footing the bill. In other words, the trade war has been little more than a hidden tax on Americans, propping up federal revenue while draining households and farms. And that brings us to the sector feeling the sharpest pain: U.S. agriculture. Just last week, Trump begged Beijing to quadruple its soybean imports to help bail out struggling American farmers. But Beijing didn't bite. In fact, they've been buying virtually zero U.S. soybeans and avoiding U.S. energy shipments as well. The pressure on American farmers is mounting. Real jobs are on the line. The cost of new equipment has soared, up 20 to 30% in many cases, and in some reports, as high as 50% or even 80%. Labor is more expensive. Loans are harder to get. For many farmers, planting next year's crop now feels more like gambling than a business plan. And here's the painful truth: the world doesn't need American soybeans anymore. Cheaper alternatives exist within the BRICS bloc, especially in South America. Brazil alone can supply China's needs without hesitation. On top of that, Beijing has been preparing for years, stockpiling reserves and diversifying supply chains. The result? U.S. soybean sales to China have collapsed. Just 2 years ago, Beijing imported nearly 5 million tons. Today, almost nothing. Overall, U.S. soybean exports have plunged from more than 10 million tons to under 5 million, a collapse of over 50%. It's a devastating blow. Farmers are warning that exports could vanish altogether, and it's not hard to see why. Tariffs have made U.S. goods uncompetitive abroad, while Trump's own import duties have raised costs at home. Selling prices are squeezed from both directions. No wonder Bessent is backing down, because whether Washington admits it or not, the U.S. economy needs China just to stay afloat. And this connects directly to Wall Street. Yesterday, tech stocks took a beating, with the Nasdaq dropping more than 2%. The big question driving markets is whether the Federal Reserve will cut interest rates. If they don't, two things happen. Bessent will have to flood the bond market with higher yield debt, pushing borrowing costs even higher for corporations, and the U.S. national debt, already at $37 trillion, could hit $38 trillion by year's end. The Fed, however, has made its priorities clear. Inflation remains enemy number one, and a majority of policymakers see it as the biggest systemic risk. That means rates are staying higher for longer, and over-leveraged companies are starting to crumble. So, what does this have to do with China? Everything. Because America's tech boom depends on artificial intelligence, and AI runs on semiconductors. To make chips, you need rare earths. And where do those come from? China. Without Beijing's supply chain, U.S. chip makers and defense contractors grind to a halt. Here's the kicker. Since the so-called truce, China has actually ramped up rare earth shipments, including to the United States. In June, exports jumped by more than 76% compared to May, when they were almost non-existent. Fighter jets, EVs, AI processors, all of it relies on these materials. Imagine what happens if Beijing pulls the plug. Overnight, U.S. tech could go from soaring to collapsing. And while Washington wrestles with that risk, Japan is sliding into its own crisis. The country is teetering on the edge of recession. July marked the sharpest export decline in 4 years, a 2.6% plunge, driven by cars, auto parts, and steel, all targeted by U.S. tariffs. Imports of crude oil, coal, and LNG also fell by double digits, signaling factories are producing less. Japan is caught in a dangerous trap. Exporting to the U.S. is no longer a winning strategy, yet Trump's goal is clear: force Japanese companies to shift production to American soil. That's deindustrialization in disguise, and Tokyo knows it. The numbers paint a grim picture. Japan, once a manufacturing powerhouse, is now running trade deficits, 117 billion yen in the red. Debt already stands at nearly 250% of GDP. Investors are losing confidence. A 20-year bond auction recently flopped, pushing yields to 2.6%. Japan is staring down a cliff, and the fall could be brutal. So where can Tokyo turn? The answer is obvious: China. And it's already happening. India, punished by Trump's tariffs, is deepening ties with Beijing. Prime Minister Modi recently met Chinese officials to discuss closer cooperation. Both countries are pushing de-dollarization, trading more in yuan instead of dollars. It's only a matter of time before Japan follows the same path. We may soon see Japanese leaders in Beijing shaking hands with Xi Jinping, exploring joint projects in robotics, semiconductors, and beyond. This is the unintended consequence of Trump's trade war. He is reshaping the global order, yes, but not in America's favor. Instead, he's driving U.S. allies and rivals alike into China's orbit. And unless Washington changes course fast, the backfire could be catastrophic. So, what do you think? Will the U.S. double back and hammer China again? Or is this the beginning of a permanent shift? And how long does Japan really have before the clock runs out? Let me know your thoughts in the comments below. Stay safe, and don't forget to hit that like button and subscribe. We'll keep breaking down these turning points as they unfold.